With interest rates rising, even incrementally, and our 6-year bull run in stocks turning rather flat this year, except for that turbulence over the summer, advisors might be wondering how they should be using ETFs in this environment as we move into the new year. We've got 2 industry experts on tap to dissect just that. Welcome back to ETF Exchange. So before we jump into 2016, let's take a look back at this year. And Alex, can you tell me what you've seen in terms of active ETFs this year and how they performed in general?
Sure. So in 2015, I think active ETFs face many of the same challenges that active managers have really since the nadir of the market in 2009, which is to say, in a bull market, they've trailed passive benchmarks. With that in mind, I'd submit that the market environment is poised to change, and that there'll be a return to active management, and we can expect outperformance.
Okay, and what have you seen, Cathie?
Much the same as Alex. Active managers have underperformed. I think it's because a lot of them are still hugging benchmarks, and so the fee makes a big difference. But we do think as the bull market evolves that there will be more risk appetite and focus on real growth, and that active management will start to pull ahead.
Yeah, and that might particularly be the case because, you know, there is a lot of uncertainty in stock markets, and with interest rates rising, you know, everybody's concerned about what to do with the fixed income side of their portfolios. So do you think, I mean, in the past, obviously advisors have been very drawn to passive ETFs and those that hug indexes. Do you see them moving more into active ETFs in 2016, Cathie?
Well, there are very few active ETFs out there. It depends on how you define active. Less than 1% of ETFs are active, and of those, 70% are fixed income. So to the extent they choose to move towards active ETFs, there aren't that many out there. But I do think if there is outperformance, in the active part of the market, they certainly will outperform. I mean, will attract assets.
Mm-hmm. And what do you suspect for this coming year?
I suspect that more advisors are going to turn to active ETFs, in part because the ETF category continues to grow. It attracts a lot of attention from advisors and end clients. I spoke with an advisor recently who had indicated that he heard from some clients and they said, "You should buy some ETFs." And he said, "Sure, what strategies, asset classes, markets are you interested in?" And they said, "I don't know, we just need to buy some ETFs." So I think active ETFs will be a beneficiary of that trend for certain.
Good. And are there any particular strategies or themes that you think might be hot in the new year ahead?
I'd say the return to active management in general is a theme that we at RISKX are really proponents of. So we can expect, for example, in the fixed income marketplace, we know rates are poised to rise. We haven't yet had that day of reckoning in the bond market. What I'd say, though, is that owning a passive index of bonds that own some longer dated maturity fixed income bonds that are going to lose value when rates rise, probably not the most prudent way to manage risk. So absolutely return to active management in 2016.
Okay, and Cathie, are there any themes that you're looking into?
Well, we're very focused on growth in a growth-starved world. So the genomics revolution, as we call it, is a very big theme. It's been hurt recently by a lot of confusion caused by deflationary, technology-related deflationary forces, but we think, it's on sale. We also are very focused on innovation in the industrial sector. When times get tough, the tough get going, and they change the way they do things. So we're seeing 3D printing, robotics and automation, artificial intelligence, autonomous vehicles move towards that, space exploration. Those are really exciting growth areas. And then, as always, the cloud, big data, Internet of Things. Jeff Bezos said in 1997, we're in day one of the internet. In his last shareholder letter, he says, we're in day one of the internet. And it is big.
Yeah, good. Well, speaking of innovation, we've also had some in the ETF market. Just recently, Eaton Vance's exchange-traded managed funds. Do you think we'll see more of that in 2016? And what should advisors know about these new products versus kind of the traditional ETFs versus mutual funds even? Alex?
So with respect to, ETMF specifically, I think that the general consensus among the distributor community, maybe not quite advisors, but their home offices and broker-dealers, is that it might be dangerous you go first. There's not quite the infrastructure around those products. We don't fully understand how exactly they're going to be the back office and record keeping, for example, is just going to be a little bit of a different story than traditional packaged products. with that in mind, I think they're an excellent opportunity. Clearly, there's a preference for active management entering the space. I think it'll be driven by the big names. It's no coincidence that the Eaton Vance ETMFs have some big portfolio management names, sort of star power folks who are attached to them. So I expect we'll see more innovation and more folks interested in those products over time.
Okay, and what do you see coming down the road?
Well, as far as the ETMFs, I think one of the reasons, again, back office indemnification, who's going to take the risks in the ecosystem. So that still has to be sorted out, and especially after August 24th and you know, everything that went around that, non-transparent, you know, I'm sure it raised a few more questions. We do think that active equity ETFs are, as we've been saying, going to continue to move on. We would like the umbrella of ETMFs, active managers, really moving forward and scaling into new instruments. That would help us. But I'm not sure it's going to happen anytime soon.
Okay. And so if we do, you know, with these new instruments and even with the vast number of ETFs out there, what is the responsibility of advisors in terms of due diligence on these products? Could you share your thoughts with us on that?
Yeah, they would be the same it would be the same due diligence they do on actively managed mutual funds. So really no difference there. In fact, many people do think of active ETFs and ETFs generally as the equivalent of stocks, and so they treat them that way in the marketplace, and we think it's very important to think about them more like mutual funds. You wouldn't ask how many shares of a mutual fund has traded today. The liquidity of the mutual fund is a function of its underlying stock. So we think it's really important to ask the questions about liquidity, but to understand that the number of shares traded for an ETF at any given time does not say anything about the liquidity. So, and I think the other things that, especially after August 24th, we need to focus on limit orders, working with ETF desks. So I think in terms of the instrument, there are things that advisors can do to limit risk significantly.
Okay, certainly, yes. And Alex, what would you say about due diligence?
So I think this is a really challenging component of utilizing ETFs for advisors. I also think it probably would behoove them to enlist some help, whether that's through the research platforms they work with, ETF strategists, or maybe even an outsourced chief investment officer sort of a platform. When it comes to ETFs, we know that there are certain types of due diligence that are specific to the vehicle. For example, you'd be interested, as Cathie had mentioned, in the liquidity of the underlying. You'd be interested in bid-ask spreads. You'd be interested in more than simply the expense ratio of the product. But from there, with active ETFs or ETMFs, you have the investment philosophy and the process of the active manager and the portfolio management team. In addition, what makes us think, or makes an advisor think, that that active manager can outperform a passive benchmark? What kind of value can they add? Is it an asset class where we think that there's some inefficiency and it's ripe for stock picking, for example? So I think all of those considerations are really paramount to advisors.
Can I add one more thing?
Sure.
Just in terms of really looking into process, philosophy, and so forth, I think what will become apparent as stocks like Walmart and IBM and the traditional old guard stumble in here, it will become very important for advisors to look for those managers who are looking into the future. So we've had some very important examples this past year that you can't just own an index because that's where all the high quality safe stocks are. There's a lot of disruptive innovation, a lot of disruption taking place like we've never seen before. So I think it's really important to dig deeply into philosophy, process, make sure that these active managers are looking to the future and not resting in a benchmark sensitive way on the past.
Okay, well those are great tips for the new year ahead. Thanks very much for joining us today.
Thank you.
Pleasure,
Thank
thank
you,
you.
Christina.